All right, let's kick things off today by playing a little game. Imagine for a second that you get to bet on a rigged coin, and this coin has a massive 99% probability of landing on heads. Would you play? I mean, it sounds like an absolute no-brainer, right? Of course you'd play. But, well, hold on just a second. Before you go all in, you need to understand the catch. Because as we all know, in the financial markets, there is literally always a catch.
And here is that catch. If the coin lands on heads, which it almost always does, you win just a tiny little 1% increase to your bankroll. But if it lands on tails, that super rare 1% occurrence, you lose a staggering 50% of everything you have. Half your money, just gone. Suddenly, this doesn't look like such a fun game, does it? A slight change in the wind or rolling two tails in a row, and you are absolutely wiped out. What looks on the surface like a nice, steady, low-risk game is actually a devastating mathematical trap.
Welcome to this explainer. Today, we're going to completely shatter the incredibly dangerous illusion that low volatility somehow magically equals low risk. We're going to decode the hidden mechanics behind sudden, catastrophic financial blowups. We'll dissect some massive structural flaws in modern investing. And, most importantly, we'll arm you with the mental models you need to protect yourself when the unexpected inevitably strikes.
We've got a really packed roadmap for you today. 1. The short volatility trap. 2. Negative convexity in mortgages. 3. Skewness versus volatility. 4. The alchemy of risk. And finally, 5. Principles of anti-fragility. Let's dive right in.
Section 1. The short volatility trap. Let's examine some massive financial strategies that rely entirely on the frankly fragile assumption that markets will just always remain calm.
So, there's this classic, honestly kind of terrifying analogy in finance. Picking up pennies in front of a steamroller. It perfectly describes short volatility trades. These are strategies that just quietly collect tiny, steady yields in calm markets. They hum along, generating really consistent small profits, which completely seduces investors into a false sense of security. But they carry a massive hidden downside, because when the market suddenly panics and volatility spikes, the steamroller accelerates, and these strategies get utterly crushed, very often wiping out literally years of accumulated gains in a single afternoon.
And listen, we're not talking about some tiny niche corner of the market here. The global short volatility trade represents a staggering $2 trillion in financial engineering. $2 trillion. This massive, system-wide scale of both explicit and implicit short volatility strategies means that market stability itself has ironically become our primary source of hidden fragility. If you look at the breakdown of this risk, it's pretty wild. At the very top, you have explicit short volatility strategies. These are funds out there actually selling options. And that sits at around $60 billion. A lot of money, sure, but that explicit risk is completely dwarfed by a massive $1.4 trillion in implicit short volatility strategies underneath it. These are funds that use incredibly complex models, like risk parity. Now, they might not explicitly short derivatives, but mathematically, they generate their returns by relying on the exact same underlying assumption, that markets simply won't suffer sudden, volatile shocks.
Now, if you're sitting there thinking, well, this is just a danger for retail investors who don't know better, let me tell you the cautionary tale of long-term capital management. Founded back in 1994 and led by actual Nobel laureates, LTCM used brilliant market-neutral convergence trades to basically print money, returning up to 43% a year. But to get those high returns on tiny little price differences, they used massive leverage. We're talking about $30 in debt for every single dollar of capital. So in August 1998, when Russia defaulted, markets diverged instead of converging. The fund lost 44% of its value in a single month. It threatened a global fire sale so bad that it literally forced the Federal Reserve to step in and coordinate a $3.6 billion rescue. So yeah, even geniuses can get completely wiped out by hidden tail risks.
Section 2. Negative convexity in mortgages. Let's see how this exact same illusion of safety is actually built right into the structural mechanics of fixed income markets.
Okay, the absolutely crucial point here is wrapping our heads around a concept called negative convexity. I know, it sounds super academic and intimidating, right? But it essentially just means that a mortgage-backed security becomes vastly more sensitive to interest rate changes precisely when you do not want it to be. See, when rates fall, homeowners prepay and refinance their houses, so the bond's duration shrinks. But When interest rates rise, nobody refinances. The duration extends, meaning the bond price becomes highly sensitive and starts dropping incredibly fast.
Just contrast how a normal bond behaves compared to one of these callable mortgage-backed securities. With a normal bond, as interest rates rise, the price falls steadily and the duration drops. It's totally predictable. But a callable MBS, the price drops aggressively. There's a great old Wall Street adage for this. A mortgage-backed security goes up like a 2-year bond when rates fall, but goes down like a 6-year bond when rates rise. This creates a really dangerous positive feedback loop in the bond market. Because if rates rise, MBS durations extend, prices just plummet, and investors take massive losses, which can then trigger way wider financial instability.
All right, Section 3, Skewness versus Volatility. We need to correct a fundamental mathematical flaw in how most investors perceive danger.
You know, most people think of risk purely as volatility. They picture the day-to-day, symmetric ups and downs of an asset's price on a chart. But true risk, the kind that permanently ruins portfolios, is really about skewness. Skewness represents asymmetric tail risk. Remember that 1% chance of a 50% loss we talked about at the very beginning with the coin flip? That's skewness. That is the steamroller. Highly negatively skewed strategies might have very low daily volatility, right up until the exact moment they suffer a rare but entirely catastrophic loss.
And that brings us to this truly mind-blowing revelation from recent financial research. What we've all been calling risk premium is actually skewness premium. Excess returns in strategies like currency carry trades, option shorting, and even some equity factors, they aren't rewards for dealing with daily volatility. Not at all. They are compensation for holding massive asymmetric tail risk. Basically, the market is paying you to act as an insurer against catastrophic events. And once you realize this, it totally changes your perspective. You stop looking at steady returns as a sign of safety, and you start asking yourself, wait, what catastrophic risk am I secretly being paid to hold right now?
Section 4, the alchemy of risk. Let's zoom out and look at the broader macro forces that are artificially inflating these really fragile market dynamics.
We are currently living in a macro environment that is perfectly illustrated by the great snake of risk. It's basically the Ouroboros of modern finance. Here's how it works. Central bank stimulus pushes yields down, which forces investors into passive indexing and risk parity strategies just to get a return. That demand suppresses volatility. Lower volatility then encourages even more leverage, which pushes markets higher, which further lowers volatility. The whole ecosystem self-organizes into one giant short volatility trade, literally nourishing itself from its own eventual destruction. And you want to know what one of the absolute biggest drivers of this snake is? Corporate share buybacks. Since 2009, U.S. companies have spent a record $3.8 trillion buying back their own stock. Look at the data here. The earnings per share without buybacks would basically be completely flat or even declining. But the reality is completely inflated by companies just buying up their own shares. And here's the thing. Any strategy that systematically buys every single decline in the market is mathematically shorting volatility. So these trillions of dollars act as this giant implicit short volatility trade, creating the sheer illusion of growth, while simultaneously building massive hidden fragility.
Section 5, Principles of Anti-Fragility. Let's finish up by exploring a practical mental model to not just survive, but actually thrive in this tightly coiled environment.
So, the brilliant thinker Nassim Taleb gives us this concept he calls the triad to categorize literally all systems. First, you have fragile. These are things that are actively harmed by volatility and shocks. Like dropping a teacup on the floor. It shatters. It's fragile. Then you have robust. Things that resist volatility. Think of a rock. You drop it, it stays the same. But here's the key. The opposite of fragile isn't robust. The opposite is anti-fragile. These are systems that actually benefit and grow stronger when unexpected, volatile events happen. So our goal shouldn't just be to be robust enough to resist the steamroller. Our goal is to build a portfolio and honestly a life that gets stronger when chaos hits.
So how on earth do we actually do that? Enter Taleb's barbell strategy. This is the practical, real-world application of anti-fragility. It works by combining extreme paranoia on one end of the barbell with extreme risk-loving on the other. First, you clip your downside risk entirely by playing it incredibly safe with the vast majority of your assets. Think boring stuff like cash or short-term treasury bills. Then, you take very small, highly aggressive, highly speculative risks with whatever's left. You completely eliminate that beastly, dangerous, moderate risk right in the middle. By doing this, your losses are strictly mathematically capped, but your upside, your exposure to massive positive asymmetries and black swans, is theoretically unlimited.
Which brings us to the ultimate takeaway for this explainer.
I really want you to look at your investments, look at your career, look at your life systems. Are you unknowingly picking up pennies in front of a steamroller, just banking on the illusion of permanent stability? When the unexpected tail risk inevitably strikes, because it always does, are you built to shatter or are you built to strengthen? Ask yourself right now, are you fragile, robust, or anti-fragile? Thanks for joining me on this explainer today. Keep learning, keep questioning, and I'll see you next time.